Hello and welcome to Vox Markets. I am John Human, and I'm delighted to welcome back after quite a long break from our chats, John Rosier, who, as you may know, runs a very successful private portfolio, which he reports upon through his website. How are you doing, John?
All right, thanks, and yeah, good to chat again, John.
Yeah,
It
good
has
to
been
have
a
you
long
back.
time. Too long.
It has. And there's been a lot going on, both on the markets and in your portfolio, which I obviously keep up to date with through the Investors Chronicle column that you write and your own website. But perhaps we can start by reviewing 2023, because I think we last spoke sort of towards the end of summer, and we've had a bit of a market bounce since then and a bit of a wobble coming into the new year. But let's talk about 23 and how that panned out for you.
Okay. Thanks for that.
That's all right. No problem. It was terrible for everyone.
Yeah, I know.
Spoiler alert.
It was especially. I mean, I made a bit of a hash of last year. I started basically. I had too much in commodities, in commodity stocks. Perhaps maybe I was too early or whatever. But if I look back, I had too much in. I let my discipline go, actually, and I sort of followed a top-down view and just followed it too strongly. And it's not really how I think I've been successful in the past. So sort of hands up, mea culpa.
There was a strong rationale for doing that, though. I mean, the whole China reopening trade was supposed to be a little bit more exciting than it turned out to be.
Yes, it was. And I mean, I built up this position back in sort of 2021, 22. And the main reason actually wasn't so much the China reopening, or that would have been nice if it had happened, but it was this move to a green economy, electrification of energy requirements, just meaning that the demand for things like copper copper especially, I mean, that's one I'm still bullish on, because there's just not enough supply to meet demand. But clearly my timing was sort of wrong, and last year it just didn't really work. Although it's nice to see copper prices in the last month or so at 12-month highs. So hopefully there is starting to be some movement there. So I've still got quite a good exposure to commodities. I'm around 20-odd%, 23%, but I was double that at the beginning of last year. So I was, not only did I have too much, but I think I was a bit slow in sort of reacting and going, actually, this isn't working. I need to reduce my position and build up some other areas. So it was quite costly. I was down 5.1% last year. And the FTSE all share was up, 7.9. So, it's a shortfall of 13%. It's not the worst year I've had. Back in 2016, I had a shortfall of about 20%. That was the year when obviously the Brexit vote and sterling went through the floor. And if you didn't have enough sort of FTSE and overseas holdings, then you got hit. So that was a bad year. And also 2018 in absolute terms, I was down 11.9%. So look, in a long-term portfolio, you're going to have some bad years. The result was since I started in January 12, last year's result brought my annualized return down to exactly 12.0%, which is it's pretty good, actually.
It's not too shabby at all.
No, it's not too shabby, but it used to be quite a lot higher, and so I need to get back up there. Anyway, it's good to know it's back up to 12.1% now. Good. So this year's moving on. It's doing a lot better.
Yeah, things did start to improve, didn't they, from October? I think the market as a whole improved, but for you as well.
They did. 26th of October was my sort of bottom. I'm up 15%. I remember writing a few times in September and October, there will be a time, we are getting close to it, where over a 6-month period, I'll be up 20%, and over a year, I'll be up 30-odd%. Well, I'm up 15 from then, so it's not quite 20, but I think underneath everything, there's a lot of huffing and puffing about the UK at the moment. the de-equitization, takeovers, people selling UK equity funds, etc., money going out. But underneath the surface, things I think are moving in the right direction, and it won't need much, I think, to turn things round in terms of people stopping selling the UK and maybe even seeing net inflows. That'd be nice to see. But I think, if you get the market, I mean, there's been a lot of excitement this week because the FTSE 100's hit new highs, etc. But I mean, a bit more momentum like that, and success can breed success. I thought Nick Train was interesting the other day. I read, you just need a mega bid. Yeah, I mean, there's been lots of bids. It tends to have been in the FTSE 250 and small cap stocks. We had Tyneham earlier this week, but I think if you get one in the FTSE 100, I don't hold Unilever.
I thought you did. I thought you did hold Unilever.
I did. I used to. I got bored of it.
Well, it is boring.
No, I mean, I did. I just
it.
thought that it wasn't performing very well, and I sold it for a tiny profit, and I think I put it in something much better. But like that, you could imagine that receiving a bid.
Yeah. Well, I hold that one. I've stuck with my boring position in Unilever, so
Sometimes
sometimes
patience works, doesn't it?
Or laziness. Yeah. I mean, just going back to the UK market, it's still looking pretty cheap. Certainly at the bottom end of it, the smaller end of it. I mean, happy hunting ground.
In absolute terms, so against history, I mean, it's right at the bottom end of its range. But then, if it relative to other markets, it looks very cheap as well. Now, compared to the US, which I mean looks, I guess a lot of people would say overblown, very expensive. The UK would look cheap, but I mean it also looks cheap compared to European markets and even Japan. It's probably the cheapest market in the world.
Yeah. And I guess the interesting thing from my perspective about the UK is, it's often spoken of as this sort of pariah market that's, full of sort of either fusty old large caps or sort of slightly dubious small caps. But I mean, the reality is, from my view, I don't know if you agree with this, I think it's stuff full of really interesting, good quality companies.
Yeah, I mean, absolutely. When you get into the FTSE 250, I mean, Schroders in their the Schroder mid cap fund, they in their, I think, reporting accounts, which in their report for last year's performance, they came up with a great stat about the performance of the FTSE 250 over the whatever it was 20 odd years. And compared to the S&P 500, their stats showed it had actually beaten the S&P 500. The other day, I saw some figures again between 2000 and whatever it was, the bottom in 03 and 08. The UK the FTSE 100, I think, was 20% per annum against the S&P that was up 15% per annum. I think we've talked ourselves into this sort of, the UK's awful, it can never go up. And there will be a time, maybe it started, where actually we'll look back and go, that was a real bargain. We should have been, filling our boots, and we'll do better than some of these more overvalued overseas markets.
Yeah.
I mean, the problem has been that, people have been taking money out. I mean, I know people of my generation who ordinarily you would have thought might have paid off their mortgage, but money has been so cheap, they've maintained a mortgage, they've had a mortgage, kept it there, and they've had money in the equity market. But now with mortgage rates going up, they're going, well, maybe I ought to pay off a mortgage. So you can see why money has come out. But at some stage that will change.
Yeah, and I guess the other reason money's come out is because people are looking over the Atlantic and seeing a more exciting trade that they don't want to miss out on, the Magnificent Seven, and that can't run forever.
It can't run forever. I mean, I've been guilty of it slightly myself, because I not only run the JIC portfolio, which is my SIP and my ISAs, but I have a funds portfolio I've been running for a few years, so that just invests in funds. Earlier this year, I did increase my exposure a bit to some of the overseas markets. So Japan, I went up to 10% through a fund called Nippon Active Value. And I also increased my exposure a little to the US. I mean, I bought Polar Capital Technology and things.
Yeah.
But I was very careful not to take it out of the UK because, you know, I think the UK is cheap. So things like Schroeder UK mid-cap stayed there, Strategic Equity Capital stayed there. I reduced my commodities mainly to fund that.
Yeah, yeah. And the interesting thing about the fund side of things, just to focus on that for a second, is if you've been buying through trusts, that they, you know, even if you're buying overseas, they can be bought at a massive discount still because they trade in the UK.
Yeah, I mean, they're huge discounts. I mean, just today, I mean, on my funds portfolio, I could just hear the discounts. I mean, so Schroeder UK mid-caps on a 14% discount to assets. JP Morgan US smaller 13, European smaller companies, which used to be TR European growth, 11%. You know, I mean, then they've narrowed slightly some of these compared to a few months ago, but there's still some good bargains there. I mean, Polar Technologies 8% discount. So yeah.
Chunky. So with all this in mind, the UK market's looking cheap, big discounts available. Have you been shopping since we last spoke? What have you been doing with the portfolio?
Okay, well, I have made, you know, as I said, I've had too much in commodities. I have reduced that it's around 23%. You know, BlackRock, World Mining, things like that are still in there. But with some of the money that I raised, I've tried to sort of improve the quality of the portfolio, trying to really fill it with stocks where if someone said, right, you've got to go away for 10 years, I'd feel relaxed that when I came back in 10 years' time, portfolio would have done well and it wouldn't have been down to what had happened to the copper price or something. So new holdings. I bought Jet2. I just think, you know, it's still well short of the highs it hit before COVID. I mean, it's performed very well operationally. I mean, they had a trading update this morning. I think profits are up 33% on a year ago. And they're only on about 8.5 times earnings. And basically summer bookings look to have been pretty good. And with this cold weather, I should think the momentum will continue.
Yeah, still a lot of pent up demand, I think. Still
I mean,
a lot of
they're
pent
off a
up
little
demand.
today. They've had a good run. They're off a little today, but you know, I'm watching that, and I've only got about 2.5% in it, maybe, you know, one to look at. Other stocks, 4imprint. So that's I added that. I mean, they're basically pretty much not nearly 100% US. 4imprint, great return on capital, good growth, pretty small market share in the US context, and they do these things like, you know, if you wanted to have a T-shirt with Vox Markets written on it,
Yeah, we've got a few of those knocking around,
or something like that, or you wanted to hand out pens or whatever, or give me a mug with that, you know, that's the sort of stuff they do in the US. But I mean, to some extent, I'm going to come on to something in a minute. The Nick Sleep shared economy, scale economy share, but to some extent they fall in that.
Yeah, 4imprint's a funny company because it is a really high quality company. It does something that you would not expect to generate the returns that it does, and the share price has just kept going up and up and up, and no one ever seems to talk about it.
Yeah, I know. I mean, it is. It's one of those sort of FTSE 250 sort of companies that's just. I guess it does what it says on the tin. Maybe I will just come in before I talk about some other stocks. I just wanted to. I've been intrigued by a chap called Nick Sleep, who not many people have heard of, but he lives in Wandsworth. I think he lives fairly close to me. So if I ever see him on Wandsworth Common, I shall grab hold of him and try and get him to go for a coffee. But he He started a fund called Nomad in 2001. And between 2001 and 2015, he returned 21% per annum, which is phenomenal.
Yeah, very good.
If you'd invested in his fund, you'd have made 10 times your money. Why did it stop in 2015? That's because he closed the fund and he does other things now rather than run a sort of public fund. But I've been trying to read up, and one of the things that he really liked, and he described it as scale economies shared. So it's companies where, as they grow, they get economies of scale, but they then share those benefits or economies with their customers. So, I mean, typically it would be through pricing. It may also be by investing in service to provide a better service or whatever, but it's basically making sure that their customers go, this is fantastic, and they go back and they go back and they tell others and they build their customer base. So it cements their relationship with customers, but also makes it very difficult for competitors to come in.
Yeah.
And, I mean, for Imprint, in some ways, I mean, I'm not sure it's a stock that Nick Sleep would necessarily have invested in, but I think it has some of the attributes, very high returns on capital, lots of free cash flow, invests in the business, and, I think is growing the top line because it's providing a very good service. People, get what they want quickly, and also their pricing is competitive.
Yeah, that's exactly how I understand that it operates. That marketing departments know they can trust it, make their order, it's there the next day.
Yeah,
completely reliable.
And for Imprint have invested a lot in, I think, the service side of it, and also sort of marketing their business.
Yeah,
and say in the US context, they've got I mean, they could double in size, and they'd still have a fairly small market share.
What's the valuation on that looking like? Or certainly, what was it like when you bought it? Because I've seen that share price going up and up and up, and I've always thought, have I missed the boat on this one?
Yeah,
valuation-wise, what was it looking like?
That was the sort of how I felt slightly when you buy it. But I think I forced myself to take a sort of Terry Smith, Fundsmith approach, where even if it looks slightly expensive now, in 3 years' time or 2 years' time, you'll look back and think, actually, that wasn't expensive because the growth more than paid for it. But looking at it today on consensus forecast, so the forecast PE for this year is 20 times now. So it's 20 times, and there's a yield of 2.8%.
Yeah.
But the earnings have been upgraded throughout last year, and I think you'll probably see more upgrades this year. And traditionally, you see, historically, this has been on 30 odd times earnings. So look, it's not on 8, 9, 10 times, which a lot of stocks are. I've got stocks down on 8, 5, 9, 10 times, but I think compared to history and given its growth rate, that's fine. I was happy to pay 20 times.
Yeah. There's another company that I know you bought recently, which sort of it fits has the same sort of characteristics in terms of how well it's done. But you and others think it has further to go. Greggs. Now, this is fascinating company.
Okay, so Greggs came up on so I set up on Stockopedia a sort of proprietary screen, trying to put in the sort of attributes that a stock would need to meet Nick Sleep's sort of requirements for a stock. And there's about 11 or 12 of stocks with a market cap of over 250 million on that screen this morning. But Greggs appeared on that a few weeks ago. And again, I mean, you'd look at it. I mean, I remember looking at this 10 years ago and thinking, well, maybe I've missed the boat. And so again, for me, it was a bit of a change of saying, come on, let's have a look at this. Because this, again, is on around 20 times earnings for this year and a yield of 2.5. But The reasons I bought it are they've still got quite a lot of growth, I think, within in terms of rolling out of new stores, and they're talking around 3,000. They're at about 2.5, but they're seeing phenomenal like-for-like growth, so sales growth through the existing stores, and I think this is a case of scale economies shared. Their pricing is very keen. I've become a bit of a fan. I've downloaded the app. I just wish there was one round the corner, because cappuccino there's very good, and it's what, £2.40 or something, and a lot of places charge a lot more. So I think the pricing is keen. They've invested in service. They've invested in distribution centres, etc., and they're doing that this year. Return on capital is excellent. Cash flow is strong. So I just think there's a lot more growth to come there.
Yeah, anecdotally, I mean, I'm up in the city now. We have a Greggs around the corner. I'm very lucky in that respect. And one thing I have observed is that Greggs in London are always very busy.
Yeah.
And Mackie D's, which is getting more expensive, seems to be getting quieter. So you can, I think you can observe this if you're out and about, particularly in London, where there is, I think, a lot of expansion potential.
Yeah. No, I mean, there's no doubt it is good value if you compare it to the other providers of coffee and snacks and whatever.
Yes, I was unfortunate. I was going to Pret a Manger this morning. That's far from affordable. Such is life. So yeah, I mean, it's a really fascinating approach. It is the quality approach. Bit of a shift there. Then.
Yeah. So other ones I've had, so Luceco. The sort of lighting distributor, and also they distribute all things to do with putting lighting in, so switching, cabling, etc., etc. And they've been upgraded steadily over the last year, and they're on what, forward PE of 13.5 times, yield of 3. So, and the most recent update was pretty positive on it. So I can see some re-rating of that over the next year. Again, very good cash flow, good return on capital. Then Wilmington. So that's sort of everything to do with compliance in financial, healthcare areas like that. So they do compliance training. They also provide compliance data, so companies know what best practices, etc. And again, upgrades there. Management have a good stake in it, so our sort of interests are aligned. That's on around 16 times forward earnings and a yield of 3. So hopeful of that seems to be doing pretty well. Gamma Communications. So Gamma came up on my screen, my sort of quality value screen and all that. And I also liked, I don't know if you've seen that book.
I haven't.
Quite a good book by this, but I mean, this chap sort of, he likes his charts. So you've got this chart here, worth pointing out, that I hope this comes across.
Yeah, you can see that.
This area down here is when you sort of want to be watching, and then when it breaks out, that's when you want to buy it. Well, and so he shows it another way. These are your sort of, that's your most bullish here. I suggest people look at Gamma Communications chart, tell me what they think. It's basically gone sideways for 2 years in a very narrow channel. Has broken out, and again, performance has been good. Share buybacks they're on 16 times. They used to be valued well in the 20s. So yeah,
remind us what it does, John.
So that's basically providing to small businesses, small medium business, actually, sort of their communication, telephony, all that side of it. And I mean, they should get a boost this year from BT are turning off they're just going all digital in terms of telephones and things like that. So they basically will provide all of the sort of communications for small and medium-sized businesses.
Yeah. And there is one other company that you've bought, which I also own too. I was very excited when I saw that you'd added this to your portfolio, Hvivo.
Yes, used to be called Open Orphan.
Open Orphan,
I
that's
sort of
correct.
followed it the last few years and was surprised it didn't really perform earlier and things. But I guess what's happened there is so I mean, very quickly, what Hvivo do is they recruit people who I say volunteer. Well, they do get paid as well, but to basically do trials for new medicines and new vaccinations, etc.
Like
So
it's
they
called a flu camp, if you're
exactly.
interested in signing up.
Yes. Yeah. I mean,
Hmm. Yeah,
yeah.
I haven't volunteered yet. I'm not sure I will.
No, but there are a lot of people who do, and
Mm.
that's good for all of us. Anyway, and they have basically their place in London, and you would go along, and you'll then stay in a sort of quarantine room there while you do the trial, and they'll look at the results of it all and feed it back to the big pharmaceutical company who paid them to do the study.
And they build models out of this data as well. So they're building what they call human challenge models that essentially can then be shared across the industry to sort of expedite the drug discovery process.
Yeah, absolutely. And I guess the sort of business thing with this was that you had to build up an infrastructure. And so it's about having a fixed cost. You've got this fixed cost there of your premises and all the staffing, etc., etc. So you just needed to get to a stage where your sales or turnover was, covered that. And once it does cover that, the margin improvement coming through is quite substantial. So they moved into profit last year. They've got a very good order book. There's a lot of visibility going forward. These programs sort of I guess planned sometime ahead and things. So they've got a lot of visibility for this year, and their turnover. I mean, they're looking effectively to more or less double it. I think they've got a target of 100 million by 2028.
Yeah,
and I think given the visibility of the business, you'd be surprised if they didn't hit that.
Yeah, indeed. No, it's interesting and a very good example, I think, of what you've described as scale economies shared. It's scale is very much what's going to be driving the profits, but obviously the benefits of that get shared with the customers and all of us, in fact, society at large. One of the things I noticed just looking at your portfolio, it's a relatively small positions you've taken in Hvivo. Is this sort of the approach you take with scaling in?
I mean, I've increased the number of positions this year a bit. So I've gone up. I mean, I've always said between sort of 20 and 30. And the funny thing is, when I had 30, my performance was just as good as when I had 20. So, I mean, there wasn't necessarily any, benefit from having fewer positions. And so, yes, that's sort of my initial positions this year in all of these sort of stocks like Gamma and Hvivo and Four Imprint were all around 2 to 3% to start with. And then, I'll build them up a bit. So Hvivo at the moment is it might just be my smallest at the moment. I mean, it's 2.2%. So there's definitely scope to take that up to around 3%, and then hopefully I'll leave it to the performance of the stock to then build it up further.
Yeah, makes a lot of sense. Wow. So all change since we last spoke, and it sounds absolutely fascinating, particularly the sort of slight shift in strategy you made. And I think there's definitely mileage in that approach. We all want to sort of go away and sleep easily at night.
Yeah, I mean, actually, in many ways, I think it's a return to what I used to do a bit. I think my commodity thing, as I say, it was to go so high was an aberration.
I think as our mutual friend John Barron puts it, it's time in the market that wins the day, not timing the market. Yeah, I think I'd agree with him.
Well, I mean, very last quick one. 3 years in June, I'm 63. 3 years ago in June, on my 60th, I read this bit about Warren Buffett, that he was 90 then or whatever, and he'd made 90% of his money since he was 60. And I thought, God, wow, blimey. I was inspired by that. 60th birthday. But the other bit, I thought, God, what's that? Anyway, that's 7.8% per annum.
Yeah.
And I think, you know, most people should aspire to do 7.8% per annum.
Yeah, definitely. If you follow a disciplined approach, like as you do, John, it's been an absolute pleasure talking to you, and let's not leave it quite so long next time.
Excellent. I've enjoyed it.
Brilliant. Thanks, John.
Talk soon. Bye.
Thanks.